Welcome, everyone. Today, we're diving into a major shift in the global economy: supply chain diversification. Companies worldwide are rethinking how and where they source their goods. What's driving this? Well, it's a mix of geopolitical tensions, trade uncertainties, and the hard lessons learned from disruptions like the COVID-19 pandemic. Resilience and risk mitigation are now as important, if not more so, than just pure cost efficiency. Several key trends are emerging from this. First, there's regionalization and nearshoring. Businesses are moving production closer to home or to allied nations. Over 90% of manufacturing executives are prioritizing regional strategies, often adopting what's called a power of two approach, sourcing from two distinct regions. This naturally leads to friendshoring, where supply chains are relocated to countries that are geopolitical allies. We're also seeing a significant push for diversification beyond China, often termed the China Plus One strategy, as companies seek alternative manufacturing hubs. Technology is playing a huge role. Companies are heavily investing in AI, machine learning, and data analytics to get better visibility into their supply chains and predict disruptions. And finally, inventory strategies are changing. We're moving away from just-in-time to a more cautious, just-in-case model, building buffers against potential shocks. So, what does all this mean for emerging markets? It's a mixed bag of opportunities and challenges. On the opportunity side, we're seeing new manufacturing hubs emerge. Southeast Asian nations like Vietnam, Indonesia, and Thailand are attracting investment in electronics, textiles, and automotive. India, with its strong demographics and IT sector, is also well positioned. Mexico is benefiting from nearshoring, especially for the US market, even seeing increased investment from China into Mexico. Sub-Saharan Africa, with its natural resources, and Latin America, a key supplier for automotive and agriculture, are also in the mix. This influx of investment can spur economic growth, create jobs, and lead to skills development. To stay competitive, these markets are also adopting new technologies, enhancing productivity. However, there are significant challenges. Infrastructure deficits, think poor transportation networks or port facilities, can be a major hurdle. Regulatory and political risks, including local laws and corruption, can deter companies. Skills gaps might impede the growth of higher value manufacturing. There's also the risk of a race to the bottom if competition is solely based on low labor costs. Trade tensions and protectionism globally can hit emerging economies hard. For resource-rich nations, sustainable resource management is key, and some are now restricting exports of unprocessed critical minerals to encourage local processing. Finally, the digital divide persists, potentially limiting some economies from fully participating in these new digitally enabled supply chains. The UNCTAD notes that in 2024, businesses diversified across multiple regions, making supply chains potentially longer as goods transit through more locations. Looking ahead, the landscape is constantly evolving. Emerging markets that invest in infrastructure, foster stable regulatory environments, develop their human capital, and embrace technology will be best positioned to capitalize on these shifts. For businesses, it's about balancing cost with resilience and geopolitical factors. As we move into 2025 and beyond, the interplay between geopolitics, technology, and a country's readiness, its infrastructure, skills, and energy resources, will continue to reshape global trade. Adaptability and resilience are truly the names of the game in this new era.